Welcome to This Explainer. Look, if you're a focused learner who wants to finally stop guessing and start trading with some real precision, you are exactly in the right place. Today, we're diving into a masterclass on a concept that completely redefines how we look at the market. We are talking about ICT Killzones and trading sessions. Now, the whole foundation we're building on today is super simple, but honestly profound. In trading, timing is literally everything. It's not just about what you trade or even that perfect pattern you see on the chart. It's all about exactly when you pull the trigger.
Okay, let's dive into our roadmap. We're going to cover why timing beats luck, the 4 major kill zones, the Asian session strategy, the daily market profile, narrative, and the 3 Bs, and finally, how to trade smart and live your life.
Section 1. Why timing beats luck. Because really, timing is 80% of the battle here.
So you can have this brilliant technical understanding of price action, right? But if you're trying to execute a masterpiece when the market is essentially asleep, well, you're going to get chopped up. I want you to really think about this for a second. Have you ever seen a perfect setup fail, hitting your stop loss, only to watch that exact same pattern absolutely fly in your predicted direction the very next day? It is incredibly frustrating. It leads to blown accounts, totally necessary emotional burnout, and just deep confusion. But let me assure you, that is not bad luck. The market isn't out to get your stop loss. It's simply a matter of market timing. You are probably just trading during dead hours when the market lacked the institutional volume, the actual fuel needed to expand.
And you know, this right here is the difference between barely surviving and actually thriving. Overtrading is a huge trap. Yes, the Forex market is open 24 hours a day. But the absolute biggest lie we tell ourselves is that we need to stare at the screen for 24 hours to catch a move. Forcing trades during those dead hours, it leads to nothing but burnout. Smart trading, on the other hand, is about operating alongside smart money. It's about logging in for very specific, concentrated 3-hour windows where institutional volume floods in. That is what gives us clean price action in those high-probability setups we're all looking for.
So how do we actually get set up for this? Well, all ICT concepts are anchored to New York time. That's the absolute baseline. Step 1, you've got to go into your platform, whether that's TradingView or MT5, and set your time zone to New York local time. That's UTC-4 or UTC-5 during the winter. Step 2, search for and apply the ICT Killzones plus Pivots TFO indicator created by Trade4Op. It literally takes all the guesswork out of the timing. Step 3, hop into the settings, set your drawing limits to 150 sessions, and keep your time frame limit to 1 hour or below. That keeps those zones perfectly accurate. And finally, color code your sessions. Make it visual. You might use blue for Asia, green for London, orange for New York AM, and purple for New York PM.
Section 2. The 4 major kill zones. Let's map out exactly where that institutional volume lives.
Think of the trading day kind of like a relay race. It has a highly specific rhythm. It kicks off at 8 p.m. Eastern Standard Time with the Asian kill zone. Then, deep in the night, for those of us in the US, the London kill zone opens up at 2 a.m. Fast forward to the morning, and the New York AM kill zone starts at 8:30 a.m., followed by the final window, the New York PM kill zone at 1:30 p.m. Each of these zones essentially hands the baton to the next one, telling a continuous story throughout the entire trading day.
Now, what's really interesting is that every single kill zone has its own distinct personality. You absolutely cannot expect the same behavior in Asia that you'd get in New York. The Asian kill zone generally has lower volatility for the US dollar. It usually moves sideways, building up liquidity, what we call the Asian high and low. It's best for trading the Aussie dollar, the New Zealand dollar, and yen pairs because naturally it overlaps with their local hours. Then comes London. This is the powerhouse, massive volatility. It often creates a fake-out move called the Judas Swing that raids that Asian liquidity before establishing what is usually the true high or low of the day. You want to stick to the euro and the pound here. Then New York AM hits at 8:30 a.m. Peak volatility, high-impact news releases. This is perfect for USD pairs and indices like the NASDAQ. Finally, New York PM steps in. Slightly lower volatility than the morning, but it features that crucial 3 p.m. to 4 p.m. power hour for the final big pushes of the day.
Section 3. The Asian Session Strategy. Let's look at a simple execution model.
Let's make this super actionable right now with a beautifully simple execution model. This is an awesome setup for beginners or if you're trying to pass those funded account evaluations. To execute this, we first need to define what's called the pre-Asia period. This is the highly specific window of time between 3:30 p.m. and 8 p.m. Eastern Standard Time. Basically, before the Asian kill zone even starts. You look closely at this pre-period window. Your entire goal here is to identify the very first fair value gap, an FVG, or an order block that formed inside this time frame.
All right, here's the exact mechanical step-by-step. Step 1, on a 5-minute or 15-minute chart, just mark vertical lines at 3:30 p.m. and 8 p.m. EST. Step 2, find that first FVG or order block inside that shaded box you just made. Step 3, sit on your hands. Just wait. When the clock strikes 8 p.m. and the Asian session officially opens, watch for the price to drop or pop into that marked zone. Step 4, the moment it taps that zone and shows a reaction, execute. Put your stop loss safely behind the block and target a strict 1-to-3 risk-to-reward ratio. Once you grab your 1-to-3, you are done for the day.
But wait, what if the market doesn't leave you a fair value gap? Actually, scratch that. It's not a problem, at least. We have a liquidity alternative. Simply mark the highest point and the lowest point made between 3:30 p.m. and 8 p.m. If the Asian session opens, sweeps past one of those levels to grab liquidity, and then aggressively rejects back into the range, boom, you just trade that reversal.
Section 4. The Daily Market Profile. Understanding the daily story.
You see, getting a localized setup is great, but understanding the broader story of how an entire day unfolds sequentially, that is what turns a novice into a pro. A standard trading day has this awesome 4-part rhythm. If you memorize this, you'll stop fighting the market. First, Asia consolidates. It goes sideways and builds up a pool of liquidity above and below its range. Second, London opens and sweeps that liquidity. This is that Judas Swing we mentioned, a fake-out specifically designed to trap early retail traders into thinking a breakout is happening. Third, once the trap is set, London violently expands in the opposite direction, establishing the true trend for the day. Finally, New York opens, usually retraces slightly back into that London move to grab more orders, and then continues the expansion.
I absolutely love this analogy from the sources to explain New York retracements. Think about it. If you're halfway to school, which represents your higher time frame target, and you realize you forgot your pen, do you walk all the way back home, effectively reversing the trend? No. You stop at a nearby bookstore, buy a pen, and keep going. That bookstore represents a short retracement into a fair value gap. So don't assume every pullback is a massive reversal. Context is literally everything.
Section 5. Narrative and the 3 Bs. Decoding the chart's story.
Now, we're moving into slightly more advanced territory here, decoding the true intent behind the candles so you aren't just blindly clicking buttons when a pattern shows up. We call this the narrative, and it is the ultimate filter for your trading. It asks the question, what is this chart actually trying to tell me right now? You have to look at the daily chart to see if price just grabbed major liquidity or if it tapped into a massive higher time frame point of interest, a POI, to dictate where it's going next. If the daily narrative is super bullish and reaching for a target higher up than a sweep of a low during the London kill zone, that's highly likely just a quick stop hunt before a massive rally. It is absolutely not a reason to start blindly selling. So how do we systematically decode this narrative? We use what's called the 3 Bs. B1 is based on history. Ask yourself, what did the market literally just do? Did it tap an order block? Did it sweep an old high? B2 is based on intent. Because of what it just did, where is the ultimate draw on liquidity? Where is the magnet pulling the price next? And finally, B3 is based on range. Where are we right now relative to the dealing range? Are we too expensive up in a premium, or are we on sale down in a discount? Answering these 3 questions makes complex, higher timeframe analysis incredibly clear and digestible.
Section 6. Trade smart, live your life. We're talking sustainability in trading. Because let's be real for a second. We didn't get into trading to sit in a dark room chained to a computer desk for 14 hours a day, right? This metaphor perfectly hits the nail on the head. A farmer doesn't stare at a crop all day waiting for it to grow. That would be insane. They water it at specific, optimal times, and then they walk away and let it be. Trading is the exact same thing. You find your specific kill zone, you execute your plan when the volume is actually there, and then you close the laptop.
So here are your golden rules for a sustainable career. First, pick just one session that fits your actual lifestyle. If you work a 9-to-5 job in the US, trade the New York AM session before work. If you're in a different time zone, focus on London or Asia. Second, do not force trades outside of that window. If your setup doesn't appear in your 3-hour block, you just do nothing. Third, and this is crucial, kill zones give you high probability, but they aren't magic. You still absolutely must manage your risk and position sizing strictly. And lastly, always remember, you are paid for making highly accurate decisions, not for logging hours staring at a screen. Which brings us to our final thought. Are you going to keep burning yourself out staring at dead charts all day, losing your hard-earned profits in the chop? Or are you ready to finally master your timing, trade your precise 3-hour window, and actually live your life? The choice is entirely yours. Thanks so much for joining me for this explainer. Master your timing, stick to your zone, and we'll catch you next time.